In life, mistakes can serve as a great learning opportunity, but in finance, they can be really costly. When it comes to your personal finances, avoiding mistakes is key to long-term success. So in today's video, I'm gonna walk you through 6 of the worst mistakes I've seen DIYers make that easily could have been avoided if they would have hired the right financial planner. The first one is about an inheritance. So a couple that I worked with, they got an inheritance of about $500,000. They weren't working the financial planner. They just thought, hey, great, I have $500,000. I can use it in the future. But what they didn't understand is that this is an IRA. They were required to take it out over 5 years. They came into working with me on year 5. They were required to take $500,000 out of this account in that 1 year. It didn't matter what they wanted to do. Because of their income, they were in the 24% tax bracket, and they had a decent amount of room, call it $100,000. $100,000 of it came out at 24. All the rest of it ended up coming out at 32 and 35. The problem is they paid so much more in taxes than they needed to. If instead they would have came and worked with us in year 1, we would have been able to take out all of those dollars in the 24% tax bracket spread out through 5 years. Instead, they jumped up to 32, so 8% higher tax, plus some at 35, which is 11% higher tax. So overall, they ended up paying almost $100,000 more in taxes over that period of time than if they just would have been working with a financial planner and understood how to withdraw from this account in the most tax efficient way. The other thing that we would have done is they owned a business, they had a solo 401k, we would have deferred a ton of dollars into that solo 401k and had them live off of this IRA. So not only did they reduce that 24 down, they opened up more room in that bracket, allowing them to stay in this lower tax bracket, also invest for the future and funnel that money back in when they didn't need it today. The second one is about Roth conversions. Somebody reached out to me and said, hey, I think I need help. I want to work with a financial planner. You know, I'm in my mid 60s right now. And they had been retired for 10 years. During that 10 years, they lived off of basically cash and some bonds and a little bit from their investment account. But what they didn't realize is they were missing out on Roth conversions. So what Roth conversions allow you to do is move money from pre-tax to Roth. This is really important because for this family, they were deferring at the 37% tax bracket for the last 15 to 20 years. And that totally made sense, right? You're in the highest bracket, let's defer to the future. The problem is that because this account got so large and it's continuing to compound, they're gonna have to take out large required minimum distributions. Between these large required minimum distributions and from taking money from Social Security, they're gonna be shot up into a really high tax bracket, leading to a ton of added taxes. If instead, when they first retired, they would have started to work with a financial planner, what they would have learned is that they could have been doing Roth conversions every single year and lowering that effective tax rate. Instead, this money has been compounding in pre-tax accounts. They're gonna have a really high effective tax rate and a really high marginal tax rate versus if they would have been doing Roth conversions for the past 10 years, they would have been able to fill up lower tax brackets, lower their effective tax rate, and save hundreds of thousands of dollars in taxes over their lifetime. Number 3 is about an S corporation and a business owner. A business owner came into working with us. They had been an S corp for a number of years. And one thing they didn't understand is the qualified business income deduction. So the qualified business income deduction is the lesser of 20% of business profits or 50% of W-2 wages when your income gets above a certain threshold. When it's low, it's just 20% of business profits. But because they were over this threshold, they were making a ton of money, about $1 million a year, it became the lesser of the two. What they were always told is, hey, pay yourself the lowest reasonable salary so you pay the least amount in self-employment taxes. So they were paying themselves a salary of $100,000. And that's great. They saved self-employment taxes from 100 to 168. But what they didn't realize is they had $900,000 of profit. So 20% of that is a little over, just under $200,000 deduction. But 50% of $100,000 in wages is a $50,000 deduction. So there was $140,000 of room really between these two that they weren't optimizing. If instead they raised their salary quite a bit, they could end up fine-tuning these two numbers. And so when you end up fine-tuning these two numbers, they end up getting an added deduction of about just under $100,000. And that added $100,000 deduction is gonna save them $37,000 on federal taxes plus with state. The other benefit is because they raised that salary, now they can actually max out their solo 401k. When they were only paying themselves $100,000 in salary, they can only do $23,000 to the solo and then 25% of W-2 wages, so they could do 48, versus now when they get the salary higher, they can do the full 69,000, which is another $21,000 added deduction. So this type of tax planning ends up saving them 6 figures every single year, really between optimizing QBID, solo 401k, and then in the future, we're going to consider cash balance plans, which can just allow them to defer more and more. But again, going back to example 2, we have a great strategy in the future for Roth conversions. The next one is a story about a botched Roth IRA. Family had been over the earned income amount for Roth IRA contributions for basically the last 10 years, and they had no idea there was an income restriction on it. Both husband and wife, every single year, were putting in the max contribution. They were investing it, they were letting it grow, but what they didn't realize is that because they were doing this on a yearly basis, they had a 6% excise tax for leaving those contributions in. And now all of a sudden they realize, oh my gosh, we owe all these penalties. We're supposed to have to reverse it out. It's hard to go back that many years, so it's really hard to make that change. So make sure you understand it. And I'm going to go into a second example here. Another family we were working with did not understand how to do backdoor Roth IRA contributions. So what they were doing every year is they were putting money in their IRA, they were converting it to Roth, they were happy, and then they called it a day. But what they didn't realize is they had a large IRA for each of them that came from an old 401k. They both had about $100,000 in there. So every year when they were doing the backdoor Roth, they didn't realize that over 90% of that conversion was taxable, and they weren't reporting it right on their taxes. Now they had to go back, amend a bunch of years, realize that they owed a bunch of tax from these conversions, and instead of doing tax-free conversions, they were doing taxable conversions. When if they were working with a financial planner, they would have understood, oh great, I could have rolled that into my 401k and that would have allowed me to do backdoor Roth contributions. Or hey, I like to keep it there. Let me put some Roth dollars into my 401k, or let me do my mega backdoor Roth 401k to get those Roth dollars in. So the last one is a big one, and it has to do with 83B elections. And for those of you that don't know, an 83B election is really a way to prepay the taxes ahead of time for company stock. So what ends up happening oftentimes is I'm a founder, I'm getting founder shares. The company is basically worth 0 today. We're just getting it started. And I have this vesting schedule over a number of years. What I could choose to do, and it has to be done within 30 days of getting these shares, is I can choose to early exercise and file the 83B election and prepay taxes based on the value. So maybe you have 10,000 shares at 1 cent. You end up paying, taxes on a very small amount. This is really great because if instead you waited, these shares vested for you and became yours in the future, what would end up happening is that you would owe a lot of taxes. So somebody reached out to me and said, I didn't know about this. I was 22 years old. I started a company a couple years in. We got a bunch of capital, and now it was valued at $20 million as my shares were vesting. And I'm gonna have $5 million hit my tax return this year. What do? You can't sell those shares. There isn't liquidity for it. Nobody wants to buy the company. It's still just an idea, but you owe taxes based on $5 million. This is a problem that many people see when they miss an 83B election. So as stakes get higher, your wealth grows, you're a business owner, you're doing serious things, you need to hire the right team around you to make sure that you don't miss things like this that maybe you had never heard about. At the end of the day, my goal in this video is not to scare you. My goal here is to show you a lot of times you just don't know what you don't know. A lot of people feel like they're great financially because they understand how to budget, they save for their goals, they don't incur debt, but really that's finance 101. When you're a business owner, when you get inheritances, when you're having a lot of equity, when you're doing complex things like backdoor Roths and mega backdoor Roth IRAs and cash balance plans, etc., there's things that you don't know, and a lot of times it pays to have the right people in your corner who can help make sure that you're doing things correctly. Like I said in the beginning, mistakes in personal finance can derail your financial plan, and that is why you want to make sure you are doing all the things you can correctly. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.